What are redemption rights, and should founders give them to investors?
Redemption rights essentially give investors, after a certain period of time, the right for the company to buy them out of their investment, oftentimes with a coupon, what looks and acts a lot like an interest rate over time. So let's say an investor puts in $3 million into your company in the Series A financing, and they get, Series A preferred equity for that $3 million. Redemption rights would say 5 years from now, the investor has the right to require that the company redeem them for $3 million plus 10 or 15% or something in that range, maybe lower to 8%, accruing over that 5 years. And if they decide to redeem, the company has to pay them out. Usually it's over installments. Sometimes it's over 3/4. Sometimes it's over a couple years. The most important point, however, is that redemption rights are very disfavored in the venture community. And if you are looking at a term sheet where an investor is asking you to give them redemption rights, you might want to take a step back to the extent that you think that you're talking to a true blue VC and get a better understanding of whether the investor, maybe they're more of a private equity fund, maybe they don't really invest VC as much as you think that they might, but it's the type of red flag where we always tell people, if you don't have to, you really don't want to give redemption rights. It makes equity look a lot more like debt. One thing you're going to have to think about is the tax effect of what you're giving to investors, because the IRS oftentimes would look at redemption rights and say the equity should be treated like that. So it changes a little bit the characteristic of the investment. But the biggest point is you want to take a step back and think about whether this is the right investor partner for your company, because it's the type of thing that we don't really tend to see. And when we do see it, especially in earlier stage companies, we don't really like it.